you hear a lot of VCs say, focus on the product and engineering of it. And you're the best salesperson. So
there's kind of this tendency sometimes to get wrapped up in the SG&A or whatever, the back end administration, like what's my entity structure and, where do I incorporate and da, 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 da.
And they get caught up and they're smart enough to figure it out. I can't tell you all. I mean, a lot of our founders are super smart because that's the right use of their time is what I ask them, right? If you're doing accounting or structure, then you're not focused on what is critical at this early stage, which is getting traction, getting more customers, getting brand awareness.
Building the right thing for the right people and getting them to pay you for it. That's like the two things.
As VCs say, get the best team around you that you can convince to do what they do best, right? We play one position and that one position very well.
Hey everyone, welcome back to the Ignite podcast. Today we're joined by Frank Mastronuzzi. He's a CFO and a financial strategist with a track record of transforming financial operations for high-growth startups. With experience at Punch Financial, Frank's expertise lies in outsourced bookkeeping and financial strategies tailored for high-growth companies. Welcome, Frank.
Thanks for having me, Brian.
Yeah, I'm excited to talk to you. Maybe you could share a little bit about your journey into finance and some of those kind of pivotal moments that led to the founding of Punch Financial.
Great question. My background was very traditional. I worked for Deloitte in New York and Chicago. I did financial services, health, insurance, and some manufacturing. So I had Prudential insurance. I had MetLife insurance. I did a couple of IPOs, which was kind of got me really excited about getting started in startups because I saw the end game. I'd done 2 IPOs for 3 years at Deloitte. And so I really got a good basis of accounting at Deloitte, followed my director to Motorola internal audit, which is where I fell in love with tech and got to travel the world and really saw semiconductor manufacturing, fabs being built, pager, every technology at the core. So I knew I loved technology at that point and kind of followed my combined passions and got my MBA at University of Texas in Austin because I wanted entrepreneurship specifically in tech. And so that fit the bill. That worked perfectly into my first startup. I went to Dallas to work for Match.com in the early days. And so I was the head of business development, did a lot of deals with all the distribution channels like AOL, MSN, Dr. Phil. We did a bunch, right? And kind of that's where I got sucked into startup world after Barry Diller finally bought us and IAC was formed. So when he first started acquiring us, it was part of Ticketmaster City Search and then USA Interactive. And then after he sold the USA channel, we became Interactive Corp. It was at that time I came to LA and started doing startups, got tapped by the guys at Summit at Sea. And so I went on one of the early boats to Summit and kind of kept getting asked and over by founders to help them with their accounting and finance and quickly realized that there was a big gap in the marketplace. I kept seeing these phenomenal founders with the best lawyers and the best engineers using the worst bookkeepers that they found off of Craigslist or Fiverr, or aging myself a little by using Craigslist, but
Yelp or something like that. Yeah,
exactly.
Yeah.
It made no sense to me. So hence Punch was born.
That's what a unique take. I mean, you came from the highest echelons of the accounting world, working with some of the heavy hitting companies around the world. But your passion was in startups and you realized that they had this gap. What is a unique value to using something like Punch Financial versus just hiring somebody in-house, and how should a founder think about that as they sort of start to scale? And at what point do they need to bring somebody in-house?
No, all good questions. Yeah. I would say it's really critical early on. You hear a lot of VCs say, focus on the product and engineering of it. And you're the best salesperson. So
there's kind of this tendency sometimes to get wrapped up in the SG&A or whatever, the back end administration, like what's my entity structure and, where do I incorporate?
Get caught up and they're smart enough to figure it out. A lot of our founders are super smart because that's the right use of their time is what I ask them, right? If you're doing accounting or structure, then you're not focused on what is critical at this early stage, which is traction, getting more customers, getting brand awareness. So
building the right thing for the right people and getting them to pay you for it. That's like the two things.
VCs say, get the best team around you that you can convince to do what they do best, right? We play one position and that one position very well. And why distract from that? And if you talk to any of our founders, they'll tell you, I don't have to worry about it. Frank will, and the team will lift my head when I need to look up and focus on what needs to be. And we break it down and basic English for them and always say, hey, if it was my company, here's what I would do, but it's yours, you decide, right? And here's the options. But it's good to have someone that's all they do, right?
Yeah. Yeah. That totally makes sense. So even Steph Curry has a shooting coach is what I like to say.
Exactly.
Yeah. So you should probably have somebody who knows what they're doing these back office functions.
Yeah, Brian. And what I see all the time is they're like, well, they try they cost us against some of the early, some of the competitors. And I was like, that's great, but you don't want, that early stage expertise, early on. What you need is for the next two chess moves, right? And you don't want to switch horses midstream. So finding a new accountant, systems, all that is very disruptive. As you start getting traction, to have to change, right? It's like changing quarterbacks in the middle of the Super Bowl, right? Like, no one wants to do it, right? No one wants the backup quarterback in, but when they come in, you're like, oh, I hope they're good enough. I don't call our founders clients. I call them partners. We're your finance partner until you're big enough and raise a big enough round where the venture firms and the board wants you to bring it in house. And by the way, we're thrilled when that happens because that means you're on your path, right? Yeah. And every time we've done that, that company's gone on to do really, really well, right?
Let's talk about like kind of the entry point and the exit point. So the entry point, it sounds like it'd be as early as like, hey, I just had my first month of sales. So what do I do with this?
We tend to like them to have some product market fit and not just still trying, unless, there's always exceptions because 95% of our clients are referrals from partners in the space. And so if it's a third or fourth time founder, we're like, great, you don't need revenue, right? We'll help you out. And we also really kind of do take a VC approach is also, would we put our money into something like this? Doesn't make sense, because when we first started, if you look at the genesis, it was a side hustle, right? I really didn't want to do it. And so I had to focus on, was this going to be worth my time, especially when I'm doing it nights and weekends? And so we've always kept that approach because where we've gotten to this point is all based on our success stories and who we've been associated with. And our alum is our track record. And that's what's gotten us where we are. You're right. Early stage, I say get someone that understands the business and will grow with the business. And you don't have to worry about it, replacing someone. You could always bring in a CFO if they wanted to and keep our team. A couple of other big companies, Honey was a good example. They brought in their VP of finance. Our team stayed on for a year before he hired his own team. And anytime someone quit, guess what? Guess who got the first call, right? Us to replace. So he had plenty of time to go find someone and take his time and not use 2 weeks to try to find someone that was critical to his operation.
Right. How do you think about product market fit? I'd love to know how you underwrite these startups as an investor.
Good question. I take the same approach. I've been in enough VC meetings, so I understand what they're going to tell them, right? And that's what I tell them. And I would say, don't get mad at me. I'm just telling you what I've heard over and over so that you're prepared, right? Product market fit is I would say numerous. I always like to see them get ignition on the
There's
code.
That word.
Yeah, there you go. I'm plugging you to get some traction on the coasts, West Coast, East Coast, New York, San Francisco. I always kind of look like, hey, is that your buddy that you got convinced to friends and family that took that first shot? Show me some folks that you actually had to convince that you didn't know beforehand. That's real traction for me. And we do this in the financials, which is, we'll get into a little later, but we really focus on recurring revenue. So we break out one-time revenue in the P&L and focus on recurring. And we're looking at what's recurring, who have you convinced, and how are you gaining traction in sales, right? When I was at Match in the early days and couldn't get the big guys to listen, I always went to number 3 and number 4, right? You always start smaller, convince those guys, because then 1 and 2, will take notice when 3 and 4 have done something, right?
Yeah. As you kind of look at SaaS metrics, it sounds like you do a lot of SaaS. What kind of metrics do you look for where you're like, okay, yeah, this company is really ready to take it to the next level, raise a big seed, big $5 million seed or a big $5 or $10 million A?
It is velocity, right? You hear the same. For SaaS, I don't call it SaaS anymore, by the way, Brian. I call it SAP, right? Software as a product, because of sales and use tax, which is one of the areas that is hot right now, right? Most founders aren't paying attention to sales and use tax. And the Wayfair versus South Dakota ruling created sales tax for a lot of SaaS. I always say an accountant must have come up with the term SaaS because by putting the word service online, software as a service, most services aren't taxable. So I always say, think about a plumber, right? They don't charge sales tax when they come. And so in the early days, software as a service was pitched that way so that the tax authorities and IRS would realize, oh, it's a service. No need to charge sales tax.
Oh, wow.
That all changed, right? So now you see certain states were aggressive using that it was a Supreme Court ruling Wayfair said, we don't have to collect and remit sales tax to South Dakota because we don't have traditional tax nexus, which means boots on the ground, a sales team. But the Supreme Court's
Same
ruling,
thing that the Amazon kind of fought with states about.
well, and
Eventually
Amazon,
they had boots on the ground everywhere. So yeah.
they used South Dakota and Colorado and certain states said by sheer volume and volume of transactions, you have created tax nexus, right? Because you're shipping so much product into South Dakota.
Yeah, you're using the shared infrastructure of our state.
Yes. Which is why we started seeing Airtable and all the other SaaS big guys, and Amazon AWS was the first, right? Because they say the taxing authorities said, Amazon, you have enough knowledge and expertise to be able to do this, right? And so we see that all the time. A lot of them are not getting don't have a strategy or plan in place, and they need to early on. So SaaS, to answer the beginning question, kind of we derailed, is we're looking for recurring revenue and churn in the sense of how sticky are they staying with you, right? And so if you're signing up yearly contracts, then I want to see 2 or 3 years, right? Because if it's under 1 year and they haven't had a chance to churn, then churn isn't going to mean anything. But we're looking for the stickiness and adoption. So not only also did they sign up, but are they using it, right? So what average? When I was controller of Prezi for a short period of time, it was like, okay, how many minutes a month are our users using? And is that sticky, right? And now those are the folks that we knew were going to be recurring. And the folks that never signed in after signing up, that's not going to be recurring. So we look at that data, and the beauty by being in our role, as you know, all things come through accounting. So we have access to all their SaaS metrics, their merchant accounts. We have access to all those things. So we can see that information. And it's critical, like you said, of getting, B2B is great because, they tend to, once they adopt, they stay longer, and B2C people can be fickle based on what's happening in the economy. So we like to see kind of at least the balance, or B2B, B2C. But B2B, B2C basically is really simple, saying don't rely on any one channel, right? Have multiple channels of revenue so that if your B2C slows down because the economy, then you're not so reliant because you have that B2B revenue. But sometimes even, Warby Parker, all those guys were smart, other companies that were like, hey, let's go to businesses and have them buy subscriptions for their employees as a benefit, right? That again is a B2C product, but they were getting large subscriptions for the user.
So as you advise an early stage founder, as a CFO would, you're advising them financially, and you've been sitting in on these like Series A VC meetings. What are you telling them if they raise $500K in a pre-seed? And now they're going out to burn that money and try to collect ARR. How are you advising them on burn multiples and capital efficiency? Does that change as they kind of grow?
It does change because every business is different. I always like to say, okay, now think about I always use it as analogy of a hurdle, right? So once you raise 500,000, what's the next hurdle? Because I always say it's about the next 2 chess moves. So what's the next hurdle you need to clear milestones? Able to go raise a Series A. So if you want your A to be a 10 or 15 on a 50 or 60 pre, then how do we get from where we are now to where it is feasible to be requesting, right? And the pendulum has swung, right? Before it was like grow at all costs. It's not. No, it's no longer that. It's grow effectively and efficiently and pay attention to COGS and margin. And it doesn't have to be the best margin in the world, but it has to be a margin where you have the levers that you can pull to manage those and increase those margins later on as you grow. So for me, early on, you're trying to throw a lot of spaghetti at the wall and see what channels are sticking so that you're not, again, I see a mistake happen where they find one channel that's working and they beat that horse till it's dead before they find another channel. And then what happens? There's a dip, right? So we always say start spreading the love early and figure out what levers are working. So the best way to raise money is, hey, we found 5 channels that are working. We just don't have enough cash to go acquire all those channels. What VC wouldn't want to give them more money to go do that, right? That's the best approach. So we say, hey, focus on burn. There has to be a path to profitability. You can elect to not put that money into profit, but reinvest it back in the business. but it has to be a conscious decision, right? Because as you're seeing now, a lot of companies are struggling to raise that next round, and they're having to make whatever they raise extend. And so what's the plan for that? And that kind of gets into one of the other soapboxes I like to get on, which is actually having a real budget and using budget versus actual variance reports in your day-to-day.
And if for founders out there listening, can you maybe elucidate a little bit of the differences between what you just said, those two things?
Yeah. I always like to say that your modeling, because they get this wrong all the time. Modeling and projections are, I would say, is a perfect Wizard of Oz. If everything goes perfect, that's what your revenue would look like, right?
It's up and to the right.
Yeah.
And it's amazing. Yeah.
Hockey stick, hockey stick, hockey stick.
I love it when the financials are completely flat. I was just looking at one today. I won't name the startup, obviously. It's just like literally on his pitch deck, it's up and to the right. I'm like, oh, that's great. Like, oh, revenue tripled over the last, 6, 8, 9 months, whatever it was. And I dig into the financials. I'm like, revenue's flat. Like, how is that? It's going to go up next month. I'm like, is it?
And I agree 1,000%, Brian. I tell everyone, which is where budgeting comes in. Your first 3 months, especially after investment, you better hit that mark, right? So you better be as realistic. So I like to do budget as if things were to go wrong, what's the scorecard that you really want to be held against? And if you get excited about revenue projections and then it doesn't come in the following month, then we have to cut burn, right? And that's, we have that. Hey, you thought you're going to grow 30%, you grew 15. So that means your burn has to cut, right? So don't hire all these folks. So I teach them that we go through on a repetitive basis, the direct correlation between revenue projections and burn, right? And as I like to say, if your burns increasing, then the iceberg is getting closer faster, right?
And you just gunned it towards the iceberg.
And it's a big ship. You can't turn it that quickly. That you have to start making small pivots, right? And I don't like the P word either. So I like to say small maneuvers, right? So that you can clarify
Adjustments.
But that's where most folks make the biggest mistake, is that they don't know their numbers and they're not at control of the levers that I like to say that you need to pull. And you know that in early stage, everyone's, it's customer acquisition or sales, it's product, right? And engineering, right? Those are the big burns. And so let's focus on those. And sometimes I get caught up in some of the smaller stuff and I laugh because I'm like, you're nickel and diming the accountants and the bookkeepers, but you're spending, I won't mention names, but PR firms are getting 10K a month. And I'm like, they might get you a placement, but what is that really going to do at this early stage? It's customer acquisition, right? A lot of people think that PR in the early days is customer acquisition. It's not, right? It's getting brand awareness. It helps, but it helps with raising money and venture, but it doesn't necessarily bring in direct ROI on the PR spend. So my focus for them is, hey, let's really come out and was always exceed expectations is what we did. Always exceed the client's expectations. So manage expectations low so that you're always exceeding them. Don't
especially as you're out there raising money. So you go out, you raise the 500K, the 2 mil, whatever it is, 5 mil, and you have milestones and projections that you've shared with the VCs, right? People like me. And the VCs kind of, especially multi-stage VC, they're kind of seeing if you could stick to the plan. So that's what you're talking about. You're talking about having the wherewithal and the foresight to be a little bit more conservative with that plan and then try to hit the plan, right? And that takes a lot of maturity.
I want them to exceed the plan because then, if that's the first experience of the first 6 months of the board and you're exceeding what you promised, then they kind of get, okay, Brian's going to be the overachiever, right? And they're setting goals that are realistic and achievable versus unrealistic, right? And
it's also burn multiple do you like to see from month to month, quarter to quarter, year to year? And maybe you could define what burn multiple is for people listening that may not know.
Every business is unique. So I say every business is like a child. Everyone's pace goes differently and it never goes according to plan, right?
Every startup is a beautiful snowflake is what I like to say.
Exactly.
And it's all different.
And it never goes according to plan, right? I've been doing this too long. So with burn, to me, burn is fine. I like to see the argument of why you need that burn versus multiple. What is that accomplishing? What is the intent? If the burn is another salary, what is the goal, right? And so I always say to my teams, what are your 3 metrics that you're focused on? And if one of your employees is doing something that's not focused on those 3 metrics in the early days, tell them to stop doing it, right? You should all be focused on the three metrics, which is revenue growth, customer acquisition, whatever you're going to set the metrics. We want 10,000 fair in the early days, and some of the other startups were like TrueCar, like they wanted 500 dealerships every month, right? Whatever it was, everyone needed to be focused on the same thing. And so I always like to take burn to, hey, if you're incurring it, why? What is it doing to help you get closer to your next milestone, which is your next raise, right? And so that they're not, sometimes they raise and they think the marathon race is over. I'm like, no, the marathon race just started, right? And you need to think about all 26 miles to get to that finish line and that next raise. So for me, it's always about the next two chess moves. I tell them, right? Raising $500,000 is great, but what do we want the next two chess moves? If we want to raise a traditional A, which is 10 or 15 on a 50 or 60, great. Then we need to have about 1.5 to 2 million in revenue. And I'm big on MRR, not ARR, because MRR will show you recurring faster than ARR, right?
Yeah, 100%. Unless you're signing annual contracts and it's like, okay, we sign all annual ACV. So we're just kind of tallying up the annual.
But Brian, a lot of times what I find is they truly will let someone out of a contract, unlike maybe Carter that's been not letting people out. But if you're letting them out because you want to create a positive brand awareness in the marketplace right now, then I see everyone making that exception. So I always talk to the lawyers then and say, hey, if we've been traditionally letting people out, and it's pattern too, right? If you let out 20 people, then you can't kind of reinforce it. So I like to look at who they have decided to let out of their contracts if it is a 12-month contract. But yeah, you're right. ARR is important if it's a signed contract and from an accounting perspective, but it also is, I look at revenue recognition and what in there allows you to claim if it's time versus activity, you've earned that income.
What are some other financial pitfalls you see commonly in these startups?
It still happens all the time, hiring too fast, right? And then you have to do a riff. I'm like, I always like to say, stretch your folks until they're like, hey, if I can hand off 50% of my job description and focus on this other 50% and drive more revenue, that's what you want. I always let the team, even in my own company, I make the team justify the need to hire someone else so that they can focus on other clients. And so it's that kind of that approach to it, because in the early days, that's one pitfall. The other is not really measuring the ROI on ad spend or customer acquisition and truly having cohort data. So if they don't have a service that allows them to analyze the cohort data, then it becomes problematic. And then the last big area that I say founders, they're always saying, hey, I don't need to worry about it until later on, but I see it all the time. You got to be focused on tax from day one. And it's an area that most founders don't really like. And no, even myself as a CPA doesn't like it, but I've seen too many deals go sideways because the tax liability out there at the end during an M&A deal is too big for the acquiring company to take the risk. Right.
Maybe you can unpack that a bit. I haven't heard of this before.
Yeah. So there's three areas that have a risk opportunity to the investors and the founders. One is, like we mentioned back earlier with SaaS and SAP, right? Sales and use tax, right? They're not paying attention. And most states, the lowest common denominator across states, because we're down to the state level, is when you cross about 20,000 in cumulative sales into their state, then you should start registering and collecting and remitting sales tax. Every state's different. So if you want to use an Avalara or something like that, or Zamp to help you track it, then they monitor by state and they're looking at ship to addresses or eyeballs or where the customer is based. But that's one area. Second is with COVID and people hiring remotely, they've created tax nexus in states by hiring employees in states, right? But they're not filing state tax returns in those states. And they then quickly realize that they should have been filing in 10 states because they have employees in 10 states, right? Even if they didn't have revenue in those states, they should have been filing state tax returns. So
Does that mean if they have an employee on the ground in some state, they have to pay sales tax on sales in other states?
So if they had an employee on the ground, they have to file a state income tax return. So this is where a lot of founders get confused. So federal and state tax returns, right, are one category. Sales tax is a whole different section, right? So the state returns and federal returns where people are missing are states, right? So if I hire someone, in a state, and then that immediately creates tax nexus. You might have a loss in that state because you don't have any revenue in that state that you hired someone, but now you have expenses, you have their payroll, right? So getting a good tax firm or having a good partner like us that knows that you need a good tax firm. I like to say we're a good general practitioner doctor, but we know enough to know when you need a specialist and who you should talk to, right? And that's one area. The other is sales and use tax that I mentioned. And then the last is I see this mistake happening a lot. A lot of people are doing R&D tax credits. A lot of the payroll firms like TriNet and Gust and all those guys, but they're starting to get challenged and no one's talking about it because I use the analogy of if you take mileage on your car, you're technically supposed to track every trip and have a log, right? There's software, Mileage IQ, which Microsoft bought, which does it for you on your phone, right? Because it knows when you're going over a speed limit, certain limit, you can't be walking, right? You got to be driving. That's a good example, but you need a full study of the R&D to support the tax credit. And now a couple of, I won't mention names here, but a full CTO's time. So they filed without doing the full study. What happens when you file without doing the full study is if they challenge the IRS and you don't have the backup, then they can disallow certain deductions for your R&D tax credit. Now, if you know about the R&D tax credit, it's 1-for-1. It goes against your payroll taxes, right? So people love it because it's a way of conserving cash burn fast. But if it's disallowed, what's happened to a couple startups is they disallowed their R&D tax credit and they can go back up to 7 years, but they want 4 years, right? And not only now they said we're disallowing the CTO's time because you didn't document how much of his time was spent on R&D properly, disallowed it. So they had to refund them. But guess what? The IRS wants their interest, right?
Right. Yeah. They're 10% interest.
Penalties for not filing properly. Right. What turned out from a $600,000 credit is now $1.3 million. And here's the problem that VCs and founders need to know. The IRS and the state want their money. So even if you went bankrupt, that does not go away. It goes to the investors, i.e. the VCs. It goes to the founders. So the only way to get out of that is to die, right? So, and they're not paying attention because they're like, oh, I'll just do this quick and dirty. I always say the litmus test of knowing a real good R&D firm is if they're going to make you pay, if they get audited. So the best way to say this is they're the experts and they're coming up with the calculation, just like the guys that file your tax returns. If they're then going to say, well, if you get audited, we're not going to support the audit, that's a big red flag, right? Because if they're going to charge you more time on a calculation that they came up with, there's a problem. And so what we're seeing is I see that as a big red flag because it's like, hey, then you should have done your homework on it. That's why they sign regular tax returns. That's why most tax firms sign the return and can influence what you put on the return because their name's attached. They can tell you.
That's why I pay somebody to do my personal taxes. It's like
exactly.
Yeah.
But they're not making that connection on the R&D side. And I'm seeing it happen over and over because they think, oh, it's easy just to do this, this form that the payroll provider asked me. That doesn't cut mustard, doesn't pass the mustard. And so you're starting to see the shoe drop and it's happening more and more. And so I was trying to educate not only the founders, but the investors too, because if that goes bankrupt, the investors have to pony up. They own the company.
Right. And that's why you want to have someone like Frank at Punch Financial looking at this stuff and not, Janie's bookkeeping service who, doesn't really know startup finance law and tax law.
No offense, but most regional accounting firms say, yeah, we can do startups. Well, when I ask them what's a A or what an 83B is, and they look at me like I have three heads, then instantly it's a good, accounting is accounting, but there's strategy here with startups, right? And it's ever moving and ever changing right now. So you need someone I've been on that other side of the table, right? And I've seen transactions all the way through. So I know what holds things up. And that's why when we talk to founders, we're like, if they get it, great. We're not going to convince them that they need to use us. If they think, they're going to compare us to the low cost carrier, I'm like, great, fly Spirit. We're not Spirit, right? And you're going to have problems down the road. So I don't even want to bet on that horse problem. In my honest opinion, I feel like, if they know enough to know that they need the best support system they can, and that will help them avoid make mistakes, like MBA class case studies, right? Sometimes learning what not to do is more important than learning what to do, right, Brian? Right? Most of the case studies you reviewed is to see what other mistakes people made and why failed for them. And that's the same thing here.
How do you prep startups for QSBS? Maybe you could explain what that is. Kind of this opaque 5-year get tax-free return kind of thing. What is that?
Good question. Investors tend to really get focused on it. And so it requires the founders to have some knowledge on it. And so I think on the QSBS side with cap table management, and that's one area that I always see that is really poorly managed overall in general. So getting a expert in the space and not relying on the law firms. The law firms will do it because they have to, but that's not their bailiwick. And so they usually put on a, someone junior or a paralegal to do it. So, because they have the legal documents, but for QSBS, for founders, you want to make sure that the investors can claim the best tax benefit for their investment that they can, right? And so by making sure that you're properly following SEC guidelines and tax requirements throughout the whole process, that allows the VCs and the investors to claim the proper tax credits that they will get and use down the road on capital gains. So I am making some assumptions, but by having capital gains, and it's a big hot topic, depending on who's in the White House, but being able to claim the gain from sale of your equity as a capital gain is way more tax beneficial than as ordinary income. So if it's ordinary income, it's like you just got a paycheck, right? And you're paying state and federal taxes on those. If it's classified as a true capital gain because you've held the investment for over 2 years and it's a long-term capital gain, then the federal and state tax rates in some states come down. But federally, it definitely comes down. So from 39 to percent, it'll come down to 20%. So you're saving 19%, which is a big percentage when we're talking to big dollars. To your point, it's one of those acronyms that a lot of founders don't understand and don't want to understand. I would say the critical part there is having someone like us that understands it, that will work with the attorneys, but also making sure that corporate governance. So one of the areas that you had mentioned that they make mistakes on, corporate governance is important, meaning having annual board meetings or quarterly board meetings and those documented, right? That's good corporate governance. And you can do it via Zoom, but you need, typically that's where the law firm comes in and documents as the secretary, the board meeting minutes. And so I say all that because having good corporate governance tends to lead to good, meeting the requirements for QSBS.
Let's talk a little bit about fundraising, fundraising decks and modeling and the role that plays in attracting investors and kind of how you support the startups you work with in those areas.
Great questions. Honestly, the big mistake I always see and I always mention is, they always tend to, again, in the deck say, and then we're going to do this, and then we're going to sell the data, and then and they have 50 revenue streams, right? And then you go to the real financials and they have one, and you're like, how are you going to get 49 up started fast? No. So I say always don't have more than 3. You may have more that may come to fruition, but always just focus on 3 revenue streams, right? And your deck should be achievable. At least the next year should be, as an aggregate, should be achievable. So we always say, don't build a model that doesn't match. I'm a big advocate for having a real good chart of accounts. So if you're using the standard chart of accounts, which I see all the time that QuickBooks gives you, it was not built for a startup, right? So if I see that, I'm like, it's cringe because it means they didn't customize it to what their business is. And that chart of accounts is, if you get into level of detail that allows you to analyze budget versus actual variance and really to a meaningful level of even like spend by channel, for customer acquisition. I want to see what channels are working, what's not. When you start doing a good chart of accounts, use that chart of accounts to build your model so that when they compare the apples and oranges, the projections to the real financials, it matches.
All the same line items on the model. Yeah.
They're not like, okay, this guy was just selling vaporware, right? Like, or the dream. And some people like early stage like to have the dream, but you kind of want to show that you can, like you said, achieve the milestones that you're saying you will achieve. And so we really focus on at least the very first 6 months. I'm always like, hey, if you had to hit these numbers, are you 1,000% sure you can? even if you raise the money. And when they say no, I'm like, great, then let's lower them. The hockey stick can go steeper later, but the first 6 months are critical for building trust with your board, right? And if you miss the first 2 quarters right off the board, even a public company, if you miss projections after the first 2 quarters as CEO, you're going to have
Very tough to recover from that. Yeah.
Exactly.
Yeah. And you just turn on CNBC and watch and learn.
I say the same exact thing. I say the same exact thing,
Yeah.
which is why that leads into, we launched our own venture fund, right, Brian? We're just raising, but the reason is so we're investing alongside our portfolio companies. And for that reason, it's back to CNBC. If your CFO is investing in you, that's a good signal. So a lot of the VCs we work with, when they see that I put money in personally, or the firm has put some investment in, it really does help get their attention.
That's amazing. I love that. You're in a unique position to have seen so many different startups and their financials, kind of in the same position I am, but like a little deeper on the financial front. I love that. When you advise companies, or you're kind of starting to advise a company, and walk me through kind of like what that stack looks like. Is it QuickBooks? Like, what do you, when you get in there, you're like, oh, I'm so glad they're using that. So, or if you get in there and you're just really disappointed, maybe you could walk through some of the good, the bad, and the ugly of finance stacks.
You're good at this. You're Oprah-esque. I do say it is indicative, right? Because I always say to the founders, don't fall for the marketing hype. Like, we are in the systems all the time, so we know if ones work well. Intuit QuickBooks is the 800-pound gorilla in the US. It's not always the best fit if you have subsidiaries and you have to do a consolidation, or if you have currency conversion or inventory. Everything that Intuit does is through partnerships and APIs, which is great, but it's not fully integrated. So it doesn't always work the best. But if you look at Xero's genesis of being from Australia, they had to expand beyond Australia. The companies did. So they were going to have subsidiaries and they needed currency conversion. So I'd say, ride that horse as far as you can until you raise a Series B, A or B, depending on size. When you bring it in-house, when you bring your team in-house is when I suggest the ERP system should shift to a more robust system like Sage Intacct or NetSuite, but use the tools that will allow you to scale to that next level so that you're not, again, switching horses midstream. I always say build systems that will scale with you, and that is accounting, payroll, right? So, we're starting to see, and also us getting involved, but, a lot of the non-PEOs, like Gusto, don't have PEOs, or they're trying to add it on later. Whereas like JustWorks, I was like, hey, you need a non-PEO product like Gusto. And they launched it, right? So that you can put someone in early enough so that when you want to switch, you get big enough that you want a PEO. You're not switching payroll systems. You can stick with the same one. Banking and banking platforms. Again, I'm big on having a treasury function and 2 banking relationships. You have an operating account where you're running, people know the ACH and routing number for that account. It's for payroll. It's for, accounts payable. But most of your money is in another account, and you sweep it into the operating account when you need it, right? So, and I also say that's how you build. You can use a neobank. I love Ro. I love Mercury. They're great.
Shout out to Mercury. I love their software. Just works so well.
They're great, but they don't have full banking relationships. So when you need a venture debt need into getting venture debt, or a founder needs to get a mortgage, Mercury's not going to do that. I think their technology is incredible, but they haven't fully baked out, and rightfully so. They're not a full bank, right? So you need 2 relationships. And so I always push that. So banking is important for that treasury function. And if you have excess cash, have it working for you, not high risk, but also getting an investment procedure approved by your board. So the money's in T-bills or something else, and that's approved by the board. I see folks buying crypto. Like, I don't think your investors would be happy that you're gambling that much on your excess cash, right? Insurance and insurance providers. I think most startups are underinsured because the founders think the cash, could be better used. And I think they're putting themselves at risk. And I think most startups are underinsured, especially EPL, D&O, tech liability, all those, right? So a vouch or an broker are those guys more inclined to understand the challenges of startups than a traditional insurance brokerage firm. SaaS, like you said, I like Maxio and the SaaS analysis services like them that allow you to analyze cohort data.
Shout out to Randy, who was on the podcast a long time ago. The CEO of Maxio.
We've been pushing them a lot earlier stages. And then again, like the Avaleras, which is the 800-pound gorilla for sales tax, but you have a Zamp, which just got their Series A that's focused on it. Techstar was bought by Shopify, so it kind of the e-commerce route versus the startup route. And so you have, those are all extensions. And then, like you mentioned a lot, was the FP&A, the financial planning and analysis. So the systems that allow you to do analysis of how you're performing at the higher level, right? So churn and all those data points. We're also big on investor communications early on. We think that if founders are proactively communicating on a regular, consistent basis, then investors, don't get upset. I always tell the founders, if they have to ask you what's going on, it's already too late, right?
Yeah.
Right.
I have some portcos like that where I'm like, wait, I haven't heard from you guys in like 6 months.
Yeah.
Hopefully it's just, I didn't have you in the investor database. Here are the updates. The worst ones are like revenue same, that's why I haven't been sending out the updates.
Yeah. 9 times out of 10, it's because it's bad. Right.
Yeah.
But I also say that I say go ugly early. Every investor knows that it's not going to go according to plan. But what they want to know is that you're not waiting. I call it, in MBA speak, they call analysis paralysis, where you start analyzing the numbers too much. I think the founders don't do analysis paralysis in that way. They just get paralyzed because they've tried different things and it's not working and they don't know what to do next, Brian, right? And so therefore, like I said, you need to try something so that your boat, the Titanic, is not directly aligned with the iceberg. We need to start making small adjustments.
Why don't we wrap it up with a rapid fire? So what's the first thing a founder should do when setting up their finances?
Banking operations, accounting, and finding the right provider. I think finding the right provider is critical because they can help you make sure that you're getting your business licenses, all the things that you're forgetting. If they're good, they'll manage that for you.
What bookkeeping software would you recommend to a small startup before Series A, like pre-seed, just came out of their friends and family? Maybe they have their pre-seed round.
I still think getting set up on QuickBooks, I always say to some founders, I'd rather set you up and have you go on your way and then come back 6 months or 12 months later. I think, again, switching systems is very invasive. FreshBooks, a lot of folks have started doing FreshBooks. It doesn't give you the full robustness of you're going to have to switch. And when you switch, you lose historical data. Just that you start with zero.
Just start with QuickBooks. Interesting. Budget forecasting, quarterly or monthly?
Absolutely. If you're adjusting your burn quarterly, it's too late. You need to be looking. And the teams that analyze variances on a regular basis, on a monthly basis, are always the whole team, technology, marketing, all of them are pulling together. I've seen the best teams turn around companies because they're like, hey, I have extra budget. You need budget. And then they'll willfully give them some cash. So monthly, without a doubt. Measuring, it's like working out, right? If you're not measuring, I love Tonal, right? Because it gives you that instant, personal record, that gamification.
I love Tonal as well. I use it every day.
And so the same exact thing, if you didn't, and it also is a positive reinforcement. If you're hitting the numbers, you get excited. The team gets excited. It really builds a positive energy. And if you're not, then hey, people are making collective decisions. We got to cut burn. We got to cut salaries. What do we do? Do we do a RIF, or does everyone cut back some of their salary? I've seen them say, okay, we all will cut 10% of our salary to get there, but no in the next raise. So I think monthly is critical, because if you're not making adjustments regularly, you're going to wake up 6 months down the road and you're not going to have enough runway to make adjustments.
What about investor updates? What frequency would you recommend for that?
Great. Putting me on the record, I always strongly recommend that they control it from the get-go, and that's quarterly, and set your quarterly board meetings on the second half of the month so your accounting firm can close on the first half. If you do it more frequently and then you try to scale back, it never is successful. It's hard to take something back that you started. So if you go monthly, you'll be forced to stick with monthly.
Yeah, I think monthly is a very tough cadence. I was doing monthly from my venture firm, for the various things that we do. And I found it just to be too much. And so I backed off to quarterly. I think quarterly is like the right, stay in touch. Here's what's happening.
Yeah. If something surprises you, then reach out, right? And say, hey, I know it's not quarterly, but this is what good happened, or this is what bad happened. What are your thoughts, right? because board meetings should be a formality, in my opinion, because you should have had discussions with every board member before and send them. So we like the product called visible.bc, and it really is important to set that cadence and who's writing what section. So sales writing it, customer acquisition, all that is being done. We do the finance section, and we
It's really cool. What are some red flags that warn you a startup needs financial help?
if they're running the business out of the bank account. I hear that all the time. Like, you're not in college, right? So if you have $12 so you could buy a pizza, that's all you're worried about. That's a problem, right? And so if they're running it purely out of their bank account because of, and you get this, accruals and liabilities that exist that haven't been paid for, that doesn't really help you. So that's a huge red flag. I also like to say the audit trail is your worst enemy. More and more folks are looking at the audit trail. So I can go into QuickBooks and see when you closed your books, when you reconciled your bank accounts. And if you're not doing them regularly, it's a big red flag we'd like to run.
Sorry. Internal controls or flexibility, which is more important for a young startup?
Both. So, because internal controls, the key that I see is if you don't set procedures early, when you start scaling fast, Brian, the team teaches the next person coming in. And if they're not taught properly, then they're going to teach that mistake to the next person, right? So you need to have the procedure set. And so I always say, update your employee handbook and operating procedure. Also know that you can't be strict CFO because there's always things you have to be in the boat rowing with them to know that you need some flexibility. But exceptions should be the rule, not the rule. It should truly be the exception. And there should be a procedure for exception, meaning I'll approve the CFO approve the exception because this makes sense, right?
Yeah. What's your favorite metric to track startup financial health?
For me, it's gross margin. I always like to point out Marcus Lemonis from The Profit. He does it in a graphical sense. Most founders truly don't know their margin and their true margin, especially on SaaS. And so then they are falsely lulled into thinking they should be making more money. I hear it all the time. We should be making a lot more money. Well, you don't know what your real margin is. And if your margin isn't north of 55, good luck trying to be profitable. And you need to have a really good understanding of cost of goods sold. And most founders do not.
What do you think they get wrong about that margin metric? There's some common pitfalls there.
Yeah. So whether you're amortizing or capitalizing the dev costs, right? And that should be part of, and I like to say the easy metric that I like to tell other folks is if you did not have X, you could not fulfill a sale requirement. Meaning, if you promise customer support at a gold standard, then that's COGS because you promised it in the agreement, right? So in order to recognize revenue, if you have to do 12 things, then that is COGS. So they always forget the capitalization of the first development of the platform because they look at the K1s of public companies and they're like, they're just expensing. Slack already has fully developed, baked the cake of the platform. And now anything after that is just adjustments to it, right? If you haven't fully baked the cake and you're still figuring out what that product's going to be, then you should be capitalizing and amortizing to COGS.
Over what period of time you think?
Standards usually 20, depends on how fast they're going to get there, 24 to 36, no more months. But customer support, if it's required to get the sale, then it has to be COGS.
Yeah.
So AWS.
Which it kind of always is, isn't it? I mean, you can make a case that you always have to have to. Yeah.
Yeah, but a lot of them are like, oh, it's a SaaS product. I just had this, right? And I'm like, yeah, it doesn't matter that it's a SaaS product. You still need to analyze. AWS is the biggest for whatever service you're using, to help maintain that product and that service level. Whatever is required is part of COGS. And so they then realize that their margins are out of whack and therefore they'll never be profitable.
It's one piece of financial advice you'd give to early stage founders.
Know your levers. Know how to control your expenses and your burn. If you need to slow down, you need to know what levers to pull, and those have to be plan B, plan C, right? And they tend to wait too long, and then the quickest way to get burned down is to let go people, but that sends the wrong signal, right? And if they do more than one riff, then the good people start to get worried and they leave. So I always say riffs are bad in the sense that unless something drastically has changed or you lost your largest customer, don't scale up too fast, but know your levers, right? And payroll is one and customer acquisition and sales is the other. Those are the big buckets always, right?
Well, thanks so much for coming on. This is really informative. I'm sure founders out there will get a ton of value. Where can folks find you online and get in touch?
Sure. At the site at punchfinancial.com. My email is I give it out as frank@punchfinancial.com. We're Punch Financial @punchfinancial on Twitter, Instagram, TikTok, all of the above. And you can find us at the site directly.
Great. Thanks so much for coming on.
Awesome. Thanks for having me, Brian.